Now let's get into the legal side of things here. So first of all, if we go into the Wayback Machine, as they call it, and we look back at 2014, we can see their vision statement. So they say things like, if they bring all of their financial services to one trusted provider that they know well, right? So they're talking about the customer coming to them because they're going to be the trusted ones. And, their own customers, give about half of their financial business to our competitors. You can see that Wells Fargo is so bothered by that their customers are going somewhere else. So, nevertheless, they do mention that our vision has nothing to do with transactions or pushing products or getting bigger for the sake of getting bigger. On one hand, it's good, that they say that, and it means like, oh yeah, we're not worried about, specifically going after people and our competitors and getting more business. But it's a little scary that they had to point that out, that clearly that is, a very negative connotation of everything that's going on. So, we're going to see now that it sounds like they almost were going in that direction. Well, we already see this Forbes article from 2012, so from a long time ago, the art of the cross-sell, and we're going to see this is a major issue. They mentioned that they do it better than anyone. Well, maybe not legally, because we see this article from CNN Business. The U.S. government fines Wells Fargo $3 billion because of the fake account scandals. Okay, that's a $3 billion fine because they made millions of fake accounts just to reach, and this is the key, the staff at the bank were trying to reach some sort of incentive, right? If they get a certain amount of people signed up for whatever it is, a mortgage or for another bank account, they will, get a bonus. And so all these staff were pushing all of these new things, new bank accounts, and if people didn't take them, well, maybe they would forge people's signatures and they would get people to sign up anyway. Now, as part of the deal, Wells Fargo admitted that between 2002 and 2016, they falsified these bank records, and that harmed credit ratings of customers, right? Because people weren't paying fees on bank accounts they didn't even know existed, and they unlawfully misused their personal information and wrongfully collected millions of dollars in fees and interest based off of all of this. So really, really scary stuff, right? I would be very nervous if my bank did that to me. So that is going to be a really bad tarnish in terms of the reputation of Wells Fargo. And once again, this is going to be a really bad thing because the Federal Reserve has put an asset cap, right? The bank is not allowed to grow their loans, for example, because the Federal Reserve is scared. What are they doing to their customers? Are they going to be responsible? And this is a punishment as well as a check and balance, right? The bank can't grow. And so the bank is going to have to get on the up and up, and they can't grow so that if they do another one of these failures, there will be fewer people who are affected, or certainly not more people who are affected, hopefully. Now, there is going to be a criminal investigation. However, it is deferred prosecution, right? And this means they have to have continued cooperation with further government investigations. Now, what does that mean, deferred prosecution? Well, that pretty much means that they're not going to do anything criminal investigation right now. They will at a later date. Or maybe it'll be dropped. I suppose that's possible. There's a part of me that doesn't expect it to be dropped just because of how reckless and negligent this was. But, it's going to depend on what, these government investigations turn up. Now, there was also something else they mentioned, the Labor Department, which launched a probe in 2016 into allegations that Wells Fargo was committing wage theft and retaliated against whistleblowers, which is really a bad sign, seeing as though, you'd want whistleblowers in this situation with all these fake bank accounts, and yet Wells Fargo was attacking them. So not great, and not great for the future, because if employees know that they're going to be attacked for all of these, negative things that they're revealing, well, other people might not come forward, and Wells Fargo might get further into the hole with bad incentive plans or bad whatever it might be. Now, there's also this lawsuit, ATM access fee litigation. So this is against Wells Fargo Bank and Visa and MasterCard and several other banks. And pretty much it has to do with the fact that the ATM operator charges an access fee on Visa MasterCard transactions. But on other networks, this will violate the antitrust rule because the transaction charges are different amounts depending on the network. Now, this case went all the way up to the Supreme Court, and it was improvidently granted, and these cases returned to the district court for further proceedings. That means that the Supreme Court pretty much accepted, or it got all the way up to the Supreme Court, and the Supreme Court pretty much looked at it and said, hey, this is not something that we should be deciding. This should go back down. We wrongfully kind of brought it up to the next stage. So this is still going through. Now, from my perspective, this is actually not as scary as some of the other lawsuits. Why? Because it's not specifically against Wells Fargo. It's about everyone. It's about Visa, MasterCard, all these banks who are all kind of involved. And, it's not great that Wells Fargo has something else bad on their record, and there's going to be quite a bit. But nevertheless, it kind of doesn't scare me as much, just simply because it's kind of the whole system. It's not specifically Wells Fargo. Maybe I'm wrong about that. Now, there's this other issue that they had historical practices associated with freezing people's account, and it was because they suspected fraudulent activity. And so, was this done correctly? Was it done incorrectly? Were there really people doing fraudulent things on the accounts? Yes. If everything was done on the up and up and they were really good at detecting fraud, this would be great. However, obviously there was a lot of customers who were harmed because of this, because of their accounts being closed or being cut or whatever. So they're obviously looking into that, which is not great. Now there's also this whole issue of fee calculations, because you have people, having fees that were wrong with these accounts, and specifically in the wealth management. And the thing is, there's both overcharges and undercharges to customers. So on one hand, it's not, willfully, doing something negative to the client like we saw before when there were the fake accounts, or hopefully there's nothing willful. But nevertheless, it's really not good to have just negligence when it comes to charging people fees on their money. People don't like that, especially in wealth management when people are trying to make more money, specifically with the bank, and, they're getting fees. Well, I suppose overcharges are bad. Undercharges, I suppose, are good, but no one wants to feel like, they're being charged the wrong amount, I think. Now, in terms of foreign exchange business, while there was pricings inconsistent with commitments made to those customers, so once again, some sort of cheating. Is it negligent? Is it on purpose? Well, they're going to have to look into this. This is just another problem, right? Now, also in low-income housing tax credits, right? So they have these income housing tax credits that they're going to be analyzed, which have to do with financing low-income housing developments. And if you remember from last video, do watch it. We mentioned that in terms of the commercial banking section, there was a $3 billion income tax fee compared to $1.4 billion. There was these massive movements in terms of tax specifically related to low-income housing and renewable energy. I don't know how much each one plays, but obviously the federal government is a little bit nervous that maybe they took too large of a tax credit. So that's not great. Now, there's this other issue here that we see with patent infringement for mobile deposits. Once again, this is not great, but it also doesn't scare me as much. Why? Because this is not related to the customer specifically. This is a problem, obviously, for the bank. It doesn't look like a massive amount of money. We're talking about $200 million, but nevertheless, it doesn't really matter. Even if it was a larger amount of money, yes, that's not great, but to my mind, it's really the tarnished reputation of Wells Fargo. Now, there's been quite a few things going on here, but this type of thing, less bothersome to me. Now, here's another interesting thing. The bank pretty much self-identified that there were foreign banks who were using software from Wells Fargo to do transactions with countries or entities that were prohibited by the United States, specifically the Office of Foreign Asset Control. And so they came forward. They did voluntary self-disclosures. I think that's good. Once again, this is not going to help with the customer tarnished reputation, but this does actually, I think, have a positive sign in terms of the regulation and the government oversight. Here's a bank that now is coming forward with some of this stuff, and so I think that's positive. Now we have this, I don't know how to pronounce it, I apologize, but this Seminole tribe, who are being charged excess fees. So once again, excess fees. And it had to do with a miners' trust that, they're claiming the bank failed to invest properly. And, this was a tribe, a lawsuit against the bank. However, the tribe was now removed as party to the case. And pretty much the trial is scheduled for April 2020. Will this affect a massive amount of customers? No. But once again, that reputation, it's not a great look. Now, when we talk about a wholesale banking consent, so they did inappropriate conduct in connection with collection of beneficial ownership information. What does that mean? I'm not entirely sure. This is very complicated, but pretty much how they look at companies and who owns stakes and who are, the real source of benefit. In terms of beneficial ownership, they have more control over these companies. And so pretty much the bank was not looking at these things properly in terms of analyzing risk and I suppose other things as well. So that's not great. Once again, not going to affect their tarnish with customers, but this might affect their tarnish, their reputation with the commercial side. So not great that they're kind of getting hit on multiple fronts here. Now, here we have another issue from CNN Business that's not mentioned. I didn't see it in the 10K. Well, apparently there was missed deadlines for promised interest rates, when mortgages get renewed, for example, and the delays were specifically Wells Fargo. Now, of course, this is what the article is claiming. I'm not entirely sure about this. This is obviously complicated, I'm sure, and I'm sure there's fault on both sides, if I had to guess. Now, it has to do with 110,000 customers. Wells Fargo pretty much said that they believe that they're going to pay back these people who believe, that's the keyword, believe that they shouldn't have paid those fees. Obviously, the bank thinks that the client was wrong, and pretty much they're being nice and paying them back. So I think it's a little bit win-win there. Nevertheless, I'm not entirely sure, but obviously the technicalities are that the rates that were offered expire sometimes before the loan technically closes, and so it's the borrower's fault. The customer has to pay a fee for this extended rate. And pretty much the bank blamed customers for the delays, although CNN Business is claiming that it's the bank's fault. I'm not entirely sure. Like I said, I have a feeling like there's probably some fault to go around. Now, here we have another problem. A $50 million settlement over homeowner fees. What are we talking about here? Well, overcharging hundreds and thousands of dollars, for homeowners for appraisals that were ordered after they defaulted on their mortgage loans. So that's not great. And then there's these nationwide claims because people are charged more by Wells Fargo than they actually should have paid for these third-party appraisals in the first place. And we're talking about 250,000 homeowners, so not a massive amount. But once again, all these things tarnish the reputation of the bank. So really, from my perspective, not great. Now, Wells Fargo typically charged somewhere between $95 to $125, and yet the actual cost was $50, so for sure less than half. And these charges pretty much added to hundreds or thousands of dollars for over the time of a mortgage's loan. And these were cryptically labeled, so they were under other charges, so kind of suspicious and hard to understand what was going on. So, and it almost makes it look like, well, maybe the bank knew what they were doing, so not a great thing. Now, maybe the bank has, a good answer. For example, maybe the cost technically was $50, but they were fearful of other charges or other issues that might increase, and so they were covering some of the downside. I'm not entirely sure. It's hard to imagine, but once again, another problem, as they say. Wells Fargo agrees to pay almost $500 million due to some sort of auto insurance scheme. Well, what was going on here? Well, it was settled, specifically with customers with auto insurance. Wells Fargo purchased collateral protection insurance and placed that insurance on a borrower's account. And then Wells Fargo charged interest each month and pretty much ensured that the bank's CPI charges were covered first. So that's not good. Now, this was from 2005 to 2016, and specifically the Wells Fargo Dealer Services and Wells Fargo Auto Finance. So, not good. And then we have another problem with Wells Fargo Merchant Services Division overcharging small businesses for processing credit card transactions and massive early termination fees if they wanted to get out. So once again, scaring small business from Wells Fargo. And, a former employee said that they had to target these small businesses. Now, once again, this is a little bit tricky, so it sounds horrible and devious, but on the other hand, maybe Wells Fargo is saying, hey, we want to get these people, we don't have a lot of small businesses, we want to increase our small business, we think we can do well for them, let's focus on them. When you say focus on helping these people, that's a lot different than target. Target sounds a lot more malicious. Was it malicious, or was it just them being more positive and trying to focus on these clients? Always hard to tell, but you can see that CNN Business is kind of looking for the negative story against Wells Fargo, which from a newspaper standpoint makes sense. Now, they also mentioned the fact that Wells Fargo is retreating from the Midwest, and they're trying to cut costs in the wave of scandals, and they're selling all their branches from Indiana, Michigan, and Ohio. However, we're talking about $2.3 billion of deposits leaving Wells Fargo, and so when we know that there's about $1.3 trillion of deposits, this is really a drop in the bucket. The part that's scary to me, though, is let's say they want to expand in the Midwest, right? They only have 52 branches in all these states. But let's say they want to go back to the Midwest. Well, now all of these places have seen Wells Fargo and then seen Wells Fargo pretty much close their branches and sell them to somewhere else. So on one hand, it's a small amount of clients, $2.3 billion, that, are presumably not going to come back because they already got burned by Wells Fargo leaving once. I doubt people are happy about it. So on one hand, maybe there's a lot of people who weren't burned and they would go to Wells Fargo. But on the other hand, my perspective is, if I saw a bank pretty much close up shop and leave and then come back a few years later, I wouldn't run to open up a bank account with them. I'd be nervous. Now, here's another lawsuit that alleges Wells Fargo was unfairly shuffling paycheck protection programs. So this is very current, and pretty much this was against these small businesses who are seeking government-sponsored relief under the Paycheck Protection Program. So what was the problem? Well, apparently they were reshuffling these applications and prioritizing the applications that would make the bank the most money, which is not great because those are much larger businesses that would have made the bank more money. And the bank processed applications for $150,000, so smaller businesses, at twice the rate of the larger loans, and that was specifically in the last 3 days. So it almost looks like they sped up these smaller business loans just near the end after they had already front-loaded the applications for the largest loans. So that is really scary, and that's going to look really bad in this current environment of the crisis that Wells Fargo did that. Now, I did find that there were other banks who were accused of doing the same thing. If you want to be more positive towards Wells Fargo and these banks, well, maybe just these bigger companies could get their applications in much quicker than small businesses who it's just one, accountant or one owner trying to do it, whereas these massive businesses have whole teams and maybe inside contacts with, whoever it might be, congressmen or the bank itself. So maybe it's not the bank's fault. Maybe they weren't doing something wrong. Maybe that's just how they received the applications. Or maybe people did some not so great things to get the better incentives and to make a little bit more money. It's really hard to tell. And it's just not going to look good on the bank, I think, either way. Now, here we have an interesting thing. 12 firms are fined a total of $14.4 million. So, on one hand, this doesn't look so bad. It's not a lot of money. But the thing that bothered me was they were talking about customer records were supposed to be in a format that prevents alteration. And here we see Wells Fargo not just once, but also twice on this list. So $5 million. So a massive amount of these fines are specifically geared towards Wells Fargo, as far as I can tell. And, that doesn't look good to me. We have this whole problem of, Wells Fargo cheating people, and now their customer records are maybe kept in a way that could be altered and not known how they're altered. It doesn't look great from a regulatory perspective and kind of scares me a little bit. So once again, there's a massive amount of lawsuit going on here, a massive amount of regulation issues going on here. And it's not just one thing, it's Wells Fargo time after time. And, Charlie Munger, Warren Buffett, they point out that possibly because of all the incentives, they kind of drove people to do, employees to do the wrong thing that were not in the best interest of the bank or the customers. They were just in the best interest of this guy getting the incentive. Maybe that's true. We mentioned last time in the first part on Wells Fargo that pretty much their incentive program hasn't been going down, it's been going up. Maybe those incentives are more easily reached, and maybe they're less perverse, I don't know, but it scares me a little bit still that they still have these incentives and this program, and, maybe that's what was the main crux of all these issues. But we can see that Wells Fargo had a number of issues. And my assumption right now is it's very possible that every bank has these types of issues. But because Wells Fargo is being analyzed so carefully, more and more of these pop up, more and more of these are found. And that is, I think, a scary part about all of this scrutiny, is that more things can be found that maybe wouldn't be such a big deal to bring down a whole area of the government to analyze. But now that they're being scrutinized anyway, every little nook and cranny is being found. And so that has positives and negatives. The positives are, well, they're going to try and make sure not to make any mistakes. They're going to be extremely responsible in theory, as they know they're going to be scrutinized, and they're going to be really careful to keep things straight and narrow, right? That's Warren Buffett and Charlie Munger's perspective here. On the downside, like I just said, maybe even small things that aren't such a big deal become massive issues because it's just one more thing in the pile. And, sadly, there's a whole wide array of these problems in different areas of the bank. And, so they have regulatory problems, lowering the business that they can do with an asset cap. And now they have all these kind of problems with their facade with people, in terms of customers looking at the bank. Now, they still have a massive client base, but, from my perspective, still a little scary. And that's presumably built into the price. That's built into why it's so cheap. So you have to keep in mind that there's going to be a long-term perspective. These legal things will go away. The tarnish will eventually go away. And you have to really think that. And if you don't think that Wells Fargo has changed, right, maybe you go into the bank and you feel like it's still the same old incentive program, it's still the same old problems, then that should be a very big cue to you. Now, nevertheless, it's only one bank, but, these are the types of things that you can notice as just a regular customer, as just a regular person. I have no idea. I don't use Wells Fargo, so it's hard for me to know. But it's important to know about all these legal issues going forward. Okay, so, next time we're going to talk about insider trading and what's going on over there. We're going to stop it here. And once again, trying to keep these videos short. Tell me if you like it. If you don't like it, we can make more of them, hopefully, more often. And it'll possibly just be easier for you and me. But let me know. Like, comment, subscribe. Tell me what's going on, what you think is good, what you think is bad. Thank you so much.